The $100 silver window is closing. Banks just banned sales. According to the Q3 2025 report from the Silver Institute, the global silver market has just recorded its fourth consecutive year of structural deficit, with industrial demand stripping mining supply by over 230 million ounces. But the data point that has caught the attention of market analysts isn't the deficit itself. It's the reaction from the supply chain. Reports from wholesale liquidity providers indicate that several major bullion banks have effectively halted immediate physical redemption for retail-sized accounts, citing logistical constraints. This quiet restriction, what some observers are calling a soft ban on delivery, mirrors specific conditions seen prior to the 1980 and 2011 repricing events. In this video, I'm documenting a pattern that has repeated across multiple commodity cycles in recorded history to understand the mechanics of what happens when a physical asset becomes mathematically unobtainable at the spot price. Before we dive in, I want to be clear. This video is for educational and informational purposes only. I am not a licensed financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. Commodity historians and market analysts have documented a recurring sequence that appears across multiple supply-demand crises throughout history. I call this the Liquidity Capitulation Model, not as a prediction tool, but as an analytical framework for understanding how markets have historically responded to extreme supply stress. It's important to note, markets can behave irrationally, timelines vary dramatically, and past patterns don't guarantee future outcomes. History doesn't repeat exactly, but as Mark Twain allegedly said, it often rhymes. Here's how analysts break down the pattern. First, we see the structural deficit. This occurs when consumption exceeds new mine supply and recycling combined. Historically, prices remain stagnant during this phase because above-ground stockpiles, like the vaults in London and New York, are drained to fill the gap. We call this the invisible drain. Second, we see delivery friction. As stockpiles reach critical lows, just-in-time delivery systems begin to fail. Premiums on physical metal begin to decouple from the paper spot price. You start seeing delays, high premiums, and force majeure declarations. Third is the industrial panic. This is the inflection point. Industrial users who need the metal for production, like solar or electronics manufacturers, stop buying just in time and start buying just in case. They bypass the exchange and bid directly for mine supply. This leads to inventory hoarding and a rapid drain of registered exchange stocks. Finally, we see price rediscovery. The market mechanism forces a price reset high enough to destroy demand or incentivize massive new supply. Now, I'm going to walk you through two documented historical cases where this pattern emerged. Then we'll examine current data to see if similar conditions are present today. Let's start with case study 1, the silver crisis of 1979 and 1980. While popular culture attributes this event solely to the Hunt brothers cornering the market, documentation from the CFTC and historical archives reveals a deeper structural issue that aligns with our framework. The Hunts were merely the accelerant. The fuel was the deficit. According to Federal Reserve historical data and the 1980 CFTC report to Congress, throughout the 1970s, the world consumed more silver than it mined. The gap was filled by the U.S. Treasury selling off its strategic stockpile. In 1967, the U.S. Treasury held over 590 million ounces. By 1976, that hoard was effectively gone. Despite this massive transfer of wealth, the price remained range-bound between $4 and $6 for years. The invisible drain was working perfectly. Then came the friction. With the government stockpile exhausted, the market had to rely on mine supply. It wasn't enough. In mid-1979, the backwardation phenomenon appeared. Immediate delivery silver became more expensive than future delivery silver, a rare signal of physical stress. Large buyers began demanding physical delivery of their futures contracts, rejecting cash settlements. The exchange warehouses began to bleed silver. A contemporary report from the New York Times noted that silver is moving out of the COMEX vaults and onto planes bound for Europe. The price broke $10, then $20, then $30. This leads to the critical moment. As silver approached $50, equivalent to roughly $190 today adjusted for inflation, the exchanges and regulators intervened. On January 21, 1980, the COMEX board voted to accept liquidation-only orders. Buyers were effectively banned from entering new positions. You could only sell. This regulatory reset crashed the price, protecting the short sellers who were on the hook for metal they didn't have. Those holding physical metal saw a 700% appreciation in the 12 months leading up to the peak. Those holding paper contracts were subject to the rule changes and margin hikes that destroyed their positions. This historical case demonstrates that when a physical shortage becomes acute, the rules of the game can change overnight. For our second documented case, we look at the Ford Palladium Panic of 2000 and 2001. This scenario was driven purely by industrial necessity, which closely mirrors the solar demand dynamic we see in 2025. In the late 90s, Russia, the primary supplier of palladium, began delaying export quotas due to bureaucratic gridlock. According to USGS mineral commodity summaries from 2001, deficits began to mount, but auto manufacturers assumed supply would return. Prices drifted slowly higher but caused no alarm. By early 2000, the stockpile buffer was gone. Auto manufacturers realized that without palladium, they could not ship cars. The cost of the metal was irrelevant compared to the cost of shutting down an assembly line. Now, before we move forward with the specifics of how Ford responded, I need to remind you, what I'm sharing here is historical documentation and pattern analysis. This video is for educational and informational purposes only. I am not a licensed financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. So, in late 2000, the panic buying phase began. Ford Motor Company's purchasing department, fearing a total stockout, began aggressively buying physical palladium and futures contracts at any price. Later reporting by the Wall Street Journal revealed that Ford management instructed buyers to secure metal at all costs. Palladium exploded from roughly $350 per ounce to nearly $1,100 per ounce in January 2001. The high prices eventually did their job. They incentivized two things: substitution, as automakers began retooling engines to use platinum instead, and a supply response, as Russia finally released its stockpiles to capture the high prices. The price eventually crashed back down to $300 over the next 2 years. When we compare the 1980 silver case and the 2001 palladium case, distinct similarities emerge. Both experienced a stage where physical delivery became difficult. Both saw prices triple or more once the shortage narrative went mainstream. However, there were key distinctions. 1980 was monetary. 2001 was industrial. Today, in 2025, analysts suggest we are facing a hybrid scenario: industrial deficits like palladium combined with monetary instability like 1980. This shows the pattern is identifiable, but not perfectly predictive. Context matters. Before we examine the 2025 data, it is intellectually honest to consider opposing perspectives. Not all analysts agree with the supply crunch thesis. Some analysts, such as those at Metals Focus, argue that the deficit is overstated because it ignores the elasticity of recycling. The argument is that if silver hits high prices, billions of ounces of silverware and jewelry will be melted down, flooding the market and capping the price. While true for jewelry, our analysis suggests that industrial silver in solar panels is notoriously difficult to recover. You cannot easily melt down a solar farm. Other economists point out that high prices force innovation, known as thrifting. They argue solar manufacturers will switch to copper. While reports on copper plating technology are frequent, substitution requires retooling factories, which takes years, not months. The strongest counterargument is the recessionary trap. Traditional market theory suggests that commodities crash during recessions. If 2026 brings a global depression, industrial demand could evaporate. This would likely drag silver down with everything else initially, regardless of the shortage. These counterarguments deserve serious consideration. The pattern I'm documenting isn't guaranteed. Variables like global GDP growth and recycling rates are critical. Now let's examine current conditions through this lens. Current data from the Silver Institute's 2025 interim report shows the market is in a structural deficit of over 200 million ounces. This is driven by solar demand, which has grown 15% year over year, while mine production remains flat due to permitting delays in Mexico and Peru. This aligns perfectly with the 1973 to 1978 period, consumption exceeding production, eating into stockpiles. According to daily warehouse reports from the CME Group and LBMA, inventory available for delivery has fallen to multi-decade lows. Silver has been trading at a significant premium in Shanghai compared to London. This arbitrage suggests physical metal is draining from the west to the east, depleting the buffer we discussed in the framework. And look, I want to pause here for a moment. As we're diving into this current market data, specifically these vault depletion numbers, it's crucial to remember. This video is for educational and informational purposes only. I am not a licensed financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. What I'm showing you is analysis, not advice. This brings us to the banks banned sales narrative. Several retail bullion dealers have reported that sovereign mints are on allocation, which is a form of rationing. Reports indicate that taking delivery of a 5,000-ounce contract now involves delays that were uncommon 3 years ago. While not an official government ban, these friction points act as a de facto restriction on liquidity. Based solely on pattern comparison, current conditions show strong correlation with the inventory squeeze transitioning into the panic phase. We have the deficit, we have the drawdown, we are seeing the delivery friction. However, we have not yet seen the price realization. The window typically refers to this period between the inventory drain and the price reset. Analysts examining these supply-demand dislocations have modeled several potential scenarios for the coming 12 to 24 months. Scenario A is the industrial squeeze. If industrial demand remains inelastic, manufacturers bypass the COMEX and buy directly from miners. The paper price becomes irrelevant as the real price for physical metal decouples and surges, similar to palladium in 2001. Scenario B is the monetary reset. If the BRICS nations introduce a gold or commodity-backed trade settlement unit, silver could remonetize. Investment demand floods the small market, and prices rise not because of shortage, but because of currency devaluation, similar to 1980. Scenario C is the deflationary bust. If the global debt bubble pops, liquidity dries up. Silver crashes with the stock market regardless of the deficit, offering a generational accumulation opportunity before the eventual rebound, similar to 2008. What we cannot know is the exact timing of the inventory breaking point, the scale of potential government intervention, or the depth of the next recession. For those studying commodity supply-demand dynamics, here is how professional analysts typically structure their research. This is not a guide for investing, but a guide for monitoring. Analysts track the COMEX registered vault inventory daily. If this number approaches zero, the risk of a delivery failure increases exponentially. They watch the spread between the spot price and the physical price. If the spot price drops but the physical price rises, the paper market is losing control, and they monitor news from the solar sector. If you see headlines about supply chain constraints in photovoltaics, the industrial squeeze has begun. Those wanting to study these topics further should verify all data at the Silver Institute, the CME Group, and the USGS. To conclude, we've examined the Liquidity Capitulation Model, reviewed the historical precedents of 1980 and 2001, and analyzed the documented structural deficit in the 2025 silver market. The structural deficit is larger and more persistent than in previous cycles, and inventory levels are showing classic depletion signals. However, the recession variable remains a significant risk factor. I create this content to document patterns, analyze data, and facilitate informed discussion, not to provide financial advice. If you found this analysis valuable, I encourage you to check the sources mentioned. What is your perspective? Do you believe the industrial demand is unstoppable, or will the recession scenario win out? Let me know in the comments. I read and learn from every thoughtful response. Thank you for engaging with historical pattern analysis. Until next time, stay curious and stay informed.